Real estate loan options. What kind of loans can you use when you're starting out in your real estate investing journey so you can have financial freedom? Hey guys, if you're new to the channel, I'm Arianne and I retired with real estate cash flow at the age of 27, and I made this channel to help good people like you learn how to actually build true wealth and financial freedom. Sorry if I'm a little bit nasally today. I kind of have a cold, so hopefully you can bear with me through this. But people ask me all the time how we've been able to buy 50 rental properties just ourselves and how we've partnered with other investors to buy over 2,000 multifamily rentals. Well, most people don't realize that they can actually start investing with different loan options right now. So in this video, I'm going to talk through some typical loan options that most Americans have access to. And if you're not in the US, call a mortgage broker where you are. They can tell you what the options are there. There are probably similar types of loans here too. So before we talk about the loan options, I want to address the topic of debt. Yes, there are some gurus who say debt is bad, but that's like saying that a knife is bad. See, a knife isn't bad on its own. It's just a tool that can be used for good or for bad. That's the same with debt. You can learn how to use debt in a good way or you can use it in a bad way. Ideally, you're only using debt to buy cash flow producing assets. So this way, you can use a 4% debt to make 10% or more. 10 minus 4 is 6%. So you pocket an extra 6% by using that debt responsibly. So that is not bad. It's a tool, and it's up to you whether you learn how to use that tool or not. So anyway, on to the loan options. So one of my favorite loan options is the owner-occupied loan. So there's actually loans that allow you to buy a house for 0 to 3.5% down payment. So just for easy math, let's say there's a $300,000 house. A 0% down payment would mean you pay $0 to buy the house. And a 3.5% down payment would mean, you pay somewhere around 10 grand to buy that house. And what you can do is you can house hack with that 0 to 3.5% down payment loan, which means that because you're able to get into that house with such a low down payment, you can use it for investing. Watch this other video I made about house hacking and the 4 different ways you can make money with that method. So check that out. So the owner-occupied loans, here in the US, there's an FHA loan, a VA loan, and a conventional loan. I won't go too deep into those loan types because what you're gonna do is you're gonna call a mortgage loan officer or a mortgage broker and just ask them what owner-occupied loans you qualify for and what's the smallest amount of down payment you can put down, and that'll give you a good entryway into an investment property. Now you do have to live in the owner-occupied loan home for at least a year, so there's that, but you can do that pretty much every year if you want to and buy a new home every year, move out, rent out the old one, and keep doing that and build up your equity and build up your investments like that. Number 2, there is a home equity line of credit. So if you own a house right now and maybe you've owned it for a few years, you can call a mortgage loan officer and ask them what kind of line of credit you can get on your home. Usually you can get a line of credit between 80 to 90% of your home equity. And if for some reason, let's say the property's appreciated over the years or you've paid down a good chunk over the years, and let's say you have $200,000 in equity there, you could be able to tap into maybe $100,000 to $150,000 of that equity and use it to invest in another property. So that's one way to tap into a home equity line of credit. Again, don't use this for frivolous things or risky investments. Only use this if you know for sure that you can make a higher return than the home equity line of credit. Don't put your home at risk on risky investments. Do not do that, right? That's part of using debt for good and not using debt for bad. So please be responsible with your investments. Only invest in things you know for sure are going to get you a good return. Now, we are in a real estate investing channel, so the chances are you are looking at stable cash flowing real estate. So that's a good one. Not risky assets. Number 3, we have a second home loan. So a second home loan means that you can put just a 10% down payment to buy that house. The reason you can put just a low down payment is because this is supposed to be your second home. So if you like vacationing at the beach or near Disney or in the mountains, you can buy a house there. Typically, you need to actually use your second home for at least 14 days a year. And then if you do that, then the other days you're not there for the rest of the year, you can rent it out as a short-term rental. So there you have it. Not only do you have a free place to vacation, you also get to enjoy the cash flow that comes from renting it out on Airbnb or other short-term rental websites. So that is pretty awesome. Number 4, you can use normal rental property loan. So this is the normal loans that people think of when they think of rental properties. This requires a 20% down payment and sometimes 25% if you're buying 2 to 4 units, right? So that's typical. You need to save up quite a bit of money, but if you've been using the first 3 loans, right, the owner-occupied loan, the home equity line of credit, and the second home loan, chances are you've developed some sort of equity from those properties, and you also have a good amount of cash flow. So hopefully that is helping you build up a bigger down payment for the next rental property. Number 5, there are commercial debt service coverage ratio loans. So I won't go too deep into that. Those are usually 20% down payment loans as well. They're similar to the rental property loans, but you can close in an LLC instead of your personal name, which is a requirement for all of the conventional loans from 1 to 4. There are some pros on this, right? Because it is a DSCR loan, that debt service coverage ratio loan, it usually isn't reliant on your own personal income and your debt to income ratio, which the conventional loans are. It's usually more reliant on the property you're buying and how much that property can cash flow. So that's a pro for the DSCR loan. Now, usually they do have slightly higher interest rates, but if you're maxed out on loans 1 through 4 that we talked about in this video, then the commercial DSCR loan might be a good option for you. So these are the loans I recommend people starting with. Is there something you want me to cover more? If I missed something or you want me to clarify anything, please let me know in the comments below and I'll add those to my next video list. Now there are more complicated loans like hard money loans and the loans we use to buy large apartment complexes. Those are more complex and for a lot of times more risky because they are complex. So we'll leave those to another video, but if you want to watch one of those, leave a comment below. If you like this, please click that like button and the subscribe button. It really helps me out for the YouTube algorithm. We also have a free Facebook community called Faster Financial Freedom. Consider joining that group, and if you have any questions, ask them there. We have a community of helpful investors that really want others to be financially free as well. We also have a free Wealthy Weekly newsletter for more resources on investing and wealth. Check that out in the description below. If you're on Instagram, please connect with me at the Arianne Lemire for more investing and real estate tips. And for those of you who want more one-on-one coaching or consulting about real estate investing, I have a premium wealth accelerator program where we help busy professionals create financial freedom with passive income in just 1 to 3 years. Check that out in the description below. All right, guys, thank you so much for watching. Have an amazing week, and I will see you in the next video.